moment on the moderate, the balanced portfolio in the middle. And of course, we should say that these are huge generalizations. We know that every person is individual. So this is just given us an indication of how it might be done. So focusing on that moderate portfolio with 50% in equities, 40% in fixed interest, and then 10% in cash, the problem arrives if you do nothing, because the markets will move around you. So here we've taken that example and applied it to a real life circumstance. We've taken the 5 weeks up to and including March the 20th of this year. So when that big crash hit just after the coronavirus outbreak in Europe was recognized. So 50% in stocks, 40% in bonds, and 10% in cash. During those 5 weeks, using the US market as an example, the S&P 500, the key indicator of the US stock market, dropped by 29%. So that 50,000 euros, dollars, pounds would have dropped to 35,500. Bonds only dropped by 3% on the US bond index. So that would have fallen from 40,000 to 38,880. And cash, of course, during those 5 weeks stayed the same. The net effect of this, however, was if you look at the right-hand column there, that 50% allocation to stocks has dropped down to 42. The 40% allocation to bonds has jumped up to 46% of the total portfolio. And cash has jumped by a full 20% of what it was and is now 12% of the whole portfolio. So what's actually happened is that by doing nothing, this investor has become more cautious. They've increased the allocation to cash, increased the allocation to bonds, and reduced the allocation to the stock market. That might sound like a good thing when there are difficult times in the investment world, but we should be looking to benefit when markets have dropped, as we know there is only one absolute truth in investment markets, which is if things are going up, they will go down. If things are going down, they will go up, and that will continue as long as capitalism exists. So when things drop, we should be increasing our allocation to the assets that have dropped more so that we can benefit when they do return to positive movement, instead of doing nothing and letting the market change you. David.
Thanks, Ed. Just working my unmute button there, a little slow. And that's interesting, and it applies to markets moving upwards or downwards, that it may push you in the opposite direction. And so keeping an active view on a portfolio is a very valuable thing, and particularly if it's a long-term investment like a superannuation plan in Australia, where you may be looking at that over a 20-year time frame. And we know that when people do that, they tend to give it slightly less attention. So it is important to go back and review that and see that you haven't had a portfolio drift, if you like, away from where you prefer to be, where you want to be. In applying all of that to, I guess, a longer term planning concept, this is how we look at it more broadly. You're starting at a position in time and working toward where you want to be in the future, or toward a goal. That has to be overlaid with what your affordability is, and that affordability may be online, above or below. And then, of course, your risk tolerance, how much or how you are willing to invest to get that balance right, so you're not laying awake at night worrying that you're missing out on returns, or laying awake at night worrying that you're taking on too much volatility. So we have that appropriate balance. And with life, of course, it doesn't happen in straight lines as we've seen in the market. So in reality, as the market moves around, it will at times perhaps be above or below where your goal is and what you're wanting to achieve. So the principal question that we ask everyone right now when we're talking about long-term portfolio management in this volatile time is whether that investment you are holding and the mix of that investment is still aligned to the goals that you want to achieve. Do you think you'll still get to where you want to go with what you're holding? If the answer is no, well, it's been a valuable exercise to pose that question, and then you need to make some fundamental changes. If the answer is yes, well, then it might just be that rebalancing that's required, because you know you are broadly in line. And time has an important impact in relation to that. If you are represented in perhaps that first third of the graph, and whilst those early drops may look precipitous and significant, it might be that you have enough time to recover. If a drop is occurring towards the end and you hadn't been in the position to move your portfolio more conservatively to a preservation status closer to that endpoint when you might need it, you might need to make some adjustments. And then whatever your situation, if you do need to change, the options you really have are that you decide to perhaps take more risk if you have time then to apply that risk and perhaps get a higher return, or to take more time and defer the realization of a goal, and or change the goals and make them lower and more achievable and more realistic. And we're aware that at any point in time, not all of these are available to all people as well. So that's in generalities. We thought we'd move to something a little more specific now and talk about what's happening in the market, particularly in Europe, before we talk about the global position and then something about Australia specifically. But as a summary of what I guess a lot of us know of what's happening here in Europe, there are two drivers, and in the left-hand side we talk about the health and the social aspects, where the general slowdown in new cases is obviously very well welcomed and well received across most European countries, and it's causing a couple of changes. I think there are some changes in public attitude that we're seeing perhaps in the press and also anecdotally, with more people out on streets and going to parks and beaches and other things. We're seeing that slight change in government positions in some countries, with that balance between the medical, that is preserving the well-being of the population, and the capacities of the hospital, and the economic pressures as well, and early phase lockdowns happening in a number of countries across Europe. And interestingly, you know, when we talk with a lot of internationals, particularly those with primary school age children, I think they're the ones who are probably feeling it most acutely if they're able to work from home and trying to, whilst children being homeschooled. In the Netherlands here, primary schools, I think, went back about a week ago, and that caused a real mixed response just from our network of people who are worried about the well-being of their children, or themselves and spouses who are teachers, and or the relief that they can actually get some work done. So there was a real trade-off there, and it remains to be seen, I guess, how that will flow. I know secondary schools go back here in a few weeks, which will affect us in this house. Alongside of that, you had the larger economic impactors, and we saw a lot of changes and quick responses. And I think part of the responses from the central banks and the governments were that this financial downturn that we saw, particularly through February, represented on the stock markets, wasn't driven by an economic lever as such, you know, where 2008 was driven by the financial imbalances with the CDOs, the type of financial instruments that were driving the market to its higher levels, causing the crash. In 2000, it was the valuations around tech stocks driving it, and this time it was really driven by the pandemic rather than an economic driver. And perhaps that was one of the reasons we saw governments and central banks responding as aggressively as they have to support individuals, companies, and the economies. The numbers are nothing short of staggering, really, with 750 billion already committed by the European Central Bank. Germany had committed 750 billion, and are in talks right now with France for another 300 billion, in addition to the amount I've listed there for France, and 2 trillion from the US government, which is being discussed about increasing it to 3 trillion for economic support there to maintain their economies and support to avoid the economic downturns that would otherwise occur. At a personal level, that's trickling down, where if you're an organization or running an organization, there might be support for the organizations you are working for or running, in terms of guaranteeing lines of credit, support to help avoid the companies make people unemployed. And there's a lot of furloughing, a new word that's entered everyone's vocabulary recently, of putting people off without pay, without actually terminating their employment contracts. There is also support for small businesses and self-employed, both in the forms of loans and grants. There's deferral of tax payments, rent protection, banks offering some mortgage and payment holidays, and protection of overdue utility bills put forward by some governments as well. So there's lots of types of support there. And it's worth just mentioning, if you are in a position where you have those cash flow restrictions right now because you're working less, they may be worth looking into to see if there are options relevant for you. Be wary that some of these are not grants, they are loans. A bank mortgage holiday, for example, is just a deferral, and there may be interest implications in the longer term. So it's worth considering carefully, but there are some things available for you here. I'll just talk quickly about the Euro stocks and then pass back to Ed. How all that's manifested in the stock markets in Europe is reflected here in this Euro stocks, which is a collation of the main European stocks and markets across Europe, and they are fairly consistently reflected if you look at the German, the French, or any of the other major stock markets here in Europe. And it's reinforcing that volatility that we have seen. So we saw year-to-date, as at close of yesterday, we're down about 25% year-to-date on the Euro stocks market. In those 3 weeks through to the 19th of March, it was the fastest fall of 20% globally in a stock market ever. So we saw a really fast drop in the stock market, as shown in the graph there. And that was, as Ed said earlier, in response to the impact globally of the virus and Europe and US entering its lockdown phases. With all that government spending on proposed central bank support to the economies, we saw a very strong rally in April. In fact, it was the best single month on the US stock markets since January 1987. So we're in a period of high volatility. The movement itself reinforces a couple of points for us, and that is that that you should be actively rebalancing and keeping your portfolio where you want it to be, and that you shouldn't be making hasty moves to try and time a market, to try and jump to cash and jump to shares or somewhere in between, because the markets are moving that rapidly. What we have seen since the injections and promises of injections of capital from the various institutions is that whilst the markets remain quite volatile, it is around a much narrower band now, as you can see in the graph there. And I think we'll expect that to continue for some time. Ed, do you want to talk about that in the longer term context and in terms of the US?
Yeah, sure. Thank you, David. So we're using the US here because there is a wealth of data on the United States stock market. And so what you have here is on the top left of the screen, a graph showing the Dow Jones Industrial Index, which, like the Euro stocks, picks individual companies from around the market that reflect their own industrial or commercial sector. And so the Dow Jones picks those companies to represent how the US economy is doing overall, in the same way that Euro stocks picks 50 companies from across Europe. And so over the last 10 years, we can see that there have been a couple of hiccups in the US stock market, but there's been a general upward trend. And while the recent crash did wipe off 3 years worth of gains on the Dow Jones, it then quickly recovered. So it's still tracking at about where it was 2 years ago, but it has bounced quite significantly. If we then look at the graph on the bottom right, this shows the last 25 years. And so it brings into play the dot-com crisis, the dot-com crash in the early 2000s, and also the global financial crisis in 2008, 2009. But again, there's that upward trend. So whilst the markets have had their peaks and troughs, there has been a continuing trend of growth on the stock market. And if we track this back even further, back 100 years to before the Great Depression in the 1920s and 30s, then we can see a similar pattern, the growth followed by a drop. Now, moving on to the next slide, we see that this pattern has certain tendencies in every cycle. Now, this graph goes back for the last 100 years and shows periods of growth in the dark blue relative to periods of negative performance in the dark purple. And so those light blue areas are where the market was recovering to where it had been. Now, the interesting thing about market cycles is that on average, since we've been recording them, they've lasted roughly 7.5 years. But approximately 2 of those years have been negative, and the remaining 5.5 on average are positive. So periods of negative performance on the stock markets are much, much faster in general than periods of recovery and positive movement. Now, as an investor, this can help us with our financial planning. The temptation is when markets drop to react and grab the money out because we get scared. We're humans. And then when markets start to recover, it takes a very long time for people to want to push their money back into that market. They've burned their fingers or got cold feet. But knowing that the markets tend to spend on average more time in a slower growth rate and less time in a faster drop tells us that this is really not what we should be doing. When markets drop, it's very, very difficult to catch them. But when markets are growing, then we can expect that to be more of a steady trend. David.
Thank you, Ed. So the other important aspect that is or may impact us at the moment or in the near future is inflation. Inflation has, for more recent years, been quite low, but we think one of the potential outcomes of the increased government and central bank spending is inflation. There is mixed thought about this in terms of, we know that the central banks in the US and across Europe and Australia to a large extent, although they run their interest rates a little higher, tend to be fairly committed to around a 2 to 3% range. At either a lower level or a higher level, though, it can have an impact on your longer term planning, your investments, and it's worth keeping in mind. What we've got on the screen here is a graph of representation of inflation through a 30-year period, which including, as many of you may remember, that higher interest period of the 90s when we saw mid-teen double-digit inflation running through the economy. But what it basically shows is that if you had 50,000 of spending power in 1986, to maintain that same spending power in 2016, you would have needed 110,000. So your spending power has more than halved. And that's a really important thing to be mindful of when you're planning your long-term retirement. For example, if you're thinking, well, I'll retire in 20 years on 3,000 euros a month, it may well be that you actually need 6,000 euros a month by the time you get there. And it's important to keep that in mind in low or high inflation environments. This is what it's done for the last 30 years or so, 25 years or so over across Europe particularly. So we can see that it has been kept low, that the banks have been willing to go low and even negative to control it. If that continues going forward to the next medium term, next 3 to 5 years, what that might mean as a output is that taxes increase because the governments will need to recover, the economy will need to absorb this extra flow somewhere. It may mean that we'll see higher taxes. If we're living in Europe, we all know that that's a fairly high tax environment. They're not shy about increasing taxes. So it might be that that's a way that as we come out the other side of this pandemic, that we see that in company tax and also personal tax rates if we don't see inflation go up. So if we see it at 2 to 3% as it is, it has been for the last decade or so, that can be an outcome. If you're looking at inflation, some of you may know this simple math or financial rule. It's a good one to remember though, if you're thinking about inflation. The rule of 72 is a nice way to monitor and measure that. So if we were looking at inflation at 3% and you're doing that long-term retirement planning and say, okay, I want to retire on 3,000 a month in 25 years or 24 years, 72 divided by 3%, which gives you 24, is how long it takes for that purchasing power to halve. So that's where 3,000 really needs 6,000 or has the equivalent of 1,500 if you like. At the other end, you can also use it as an estimate as to how long an investment might theoretically take to double in its value. So if there were a hypothetical magical investment that produced 9% every year, and we don't have one, I think it's nice to have, but if we did, 72 divided by 9 would mean that you'd effectively be doubling your money every 8 years. So you put 100,000 in and 8 years later you have 200,000 and a further 8 years, 400, then 800, then off it goes. So that's the doubling effect. And if you wanted to work out your net return after inflation, it would merely be 9% return less the 3% inflation as shown on the example there, producing a net 6% return after inflation, or doubling your money in real terms every 12 years. So it's important to keep that in mind when you are planning for the future, that what's affordable now may not be as affordable in the future. Ed.
Yeah, so thank you, David. This is an illustration of the fact that there's actually been another story going on at the same time as the coronavirus pandemic, that up until just a couple of weeks ago was almost entirely pushed off the front pages by COVID-19 and the associated news. That running up to February of this year, there was a price war going on, a trade war between the OPEC nations and some of the other larger developers and producers of oil in the world. Principally, the main aggression and competition over prices was between Saudi Arabia and Russia, but the OPEC nations and other oil producers were sitting down around a table in February to try and come to a resolution in order to lower production of oil and therefore push the price upwards. Now, just at the end of February, these talks collapsed, and so the price of oil plummeted. It went down to around about $20 or $30 a barrel. If you consider that just a few years ago it was trading at $110 a barrel plus, that's a massive drop. Now, subsequently, as I'm sure everybody saw in the news, oil prices actually went negative on the futures market. Now, it might be a bit difficult to grasp the concept of a commodity having a negative price, so somebody paying you to receive it. But the fact is, nobody had the capacity to store the oil. And because of the way that oil is traded on the futures market, there are hundreds of times more barrels of oil bought and sold every day than actually exist at any one time. So these prices of oil were essentially the price that you were promising to pay when you take delivery of it. So when nobody had the capacity to store it because of decreased demand from lack of air travel and lack of use of cars and other vehicles, and from industrial shutdowns because of quarantine periods around the world, then it actually put these oil traders in a position where nobody wanted to accept the oil contracts that they'd already agreed to. So they were paying people to take these oil contracts on the condition that they could actually take delivery. Now, all of this on its own could have caused a crash in the stock markets. We've seen that several times in the past, most notably in the early 1970s. There was the OPEC crisis, which caused a major crash throughout the Western world and the Middle East. But combined with the coronavirus pandemic, this was guaranteed to push markets lower. And this is why we saw such a fast drop in global stock markets at the end of March this year. So the reason for this, moving on to the next slide, is that everything in global markets is based on demand side push and pull and supply side push and pull. So we've seen two different conflicting scenarios that on their own could have caused a crash in the markets, but together caused a big impact. On the demand side, we had people and companies buying less or demanding less in terms of oil and in terms of public transport, in terms of the hospitality and tourism sector. And on the supply side, at the same time, we had companies and organizations producing less because of the quarantine measures, because people were having to stay at home. And this has combined to cause the financial and stock market crisis that we've seen in the last couple of months. Now, this instability is likely to continue, partly because this demand and supply can be associated with the availability of money as well. And David mentioned at the beginning of the webinar that there's been a bit of a shift in terms of the risk profile of bonds and equities. And the reason for this is that governments around the world have tried to support the equity markets by injecting money. They've promised reduced rate loans. They've promised grants or bailouts. They've injected money in terms of buying assets or buying bonds or promising purchases on behalf of the government. Now, as David said earlier, this has been to the tune of trillions of euros around the world. The $2 trillion from the US, $2 trillion from the US government alone, 750 billion euros from the German government alone. But that money's got to come from somewhere. The typical ways that a government can fund that sort of operation are, number one, through printing money, by just supplying more euros to the market. And for every euro that you add to the market that comes off the printer, that reduces the value of every other euro that already exists in circulation. And this causes inflation. So governments don't want to print too much money because that would cause massive inflation. And David spoke about the dangers of that earlier. The other way that governments could fund this spending is by selling bonds, by selling debts. And so they will sell those bonds to individuals and businesses in exchange for a promised return in terms of interest or a coupon. And the problem with that is that as the governments sell more bonds, the demand for them reduces because there are more of them available. So people will expect to have a higher return from buying those bonds, which makes it very difficult for governments. So as the supply of money is injected into the equity market to support it, it increases the risk of government bonds from those governments that are putting the money in. So what we're seeing, in fact, is that the equity risk is reducing because governments have shown their willingness to support the stock markets, whereas the bond risk is increasing because we know that those governments are going to have to get that money back. David.
Thanks, Ed. Really good summary there. I want to shift from what's happening in that macro side and how those impacts of cash injections and so forth are changing the risk profiles to how we may adapt to and respond to that. We've been talking quite a bit recently around some of the behavioral finance responses we have in terms of how we adapt to pressures in life from a financial perspective. And there are dozens and dozens of biases, from loss aversion to locality to anchoring and all sorts of things that we do that influence the way we respond to investments and to opportunities. A really common one we see, though, is a momentum bias. I thought we'd just share that quickly because we are in a volatile market and this tends to play out more. And it is the opposite. So if we go to the store, if you go to the supermarket and you find your favorite red wine on sale, you might load up the cart and fill it up because it's on sale and the prices are cheap. When it comes to investing, though, we tend not to do that. When prices drop and are perceived as cheaper, we tend to be more nervous and worried about that. And we'd like to see performance, a momentum of a proven track record before we buy. And a good example of that is Tesla stocks, which rose strongly over the last few years. And we saw a lot of people talking about it just in the press generally. And at the beginning of this year, it seemed to be on headlines everywhere. And in a 6 to 8 week period, it almost or did double in price. And that was the point. If you look at the graph where it's gone from this looks interesting to perhaps I should buy some to I'll buy now while they're hot. And whatever happened to Tesla after that, that was in that short term, that meets that cycle of you're buying potentially at or near the top of a market, which is not when we should be buying high in that sense. Whether the stock or that asset or whatever that investment is moves through a cycle at the top, when they inevitably go down, as they will through their cycle, we go through the phases of resignation from, this will bounce to, I'll wait for them to recover, until we get to that desperation and probably almost exasperation of saying, right, I've had enough of this, sell now. My risk profile doesn't allow me to take this anymore. And if you do that, you've bought at a high and you've sold at a low, the opposite of what you're trying to achieve in investments. There are two common phrases that we hear that are related to this. One is when a stock or an asset or an investment is going up. When I hear this, it always makes me worry when they say, this time it's different, this will go up forever. We heard that a bit about Tesla. This time it's different, it's going to go up forever. That is a signal that perhaps it could be overvalued. When we're seeing a market drop and we hear this time it's different, it's going to fall forever, that's also a signal that perhaps a lot of that loss might be taken out of the market as a general guide. So we're always looking for that and moving against that broader momentum of the market. And the most famous of investors, Warren Buffett, has said, be greedy when others are fearful and fearful when others are greedy, which basically means doing the opposite of what's shown in this momentum graph. So it's worth just being mindful of that and being aware of that. If you do respond with your own investments to what's happening in the market, stop and think about what's happening in terms of the cycle, where it's at in the cycle, and what ultimately what you're trying to achieve. What's the goal you're trying to get to? When is it? And do you need to make these changes to get there, or will it in fact impede you getting there? Beyond that, I think we'll spend a minute just talking about Black Swan events, and it's not really a cheap segue and a chance for a cheap plug. It's of our name. It's to talk about the concept of Black Swan events. There's a bit of debate going on about whether or not COVID-19 is or is not a Black Swan. A Black Swan is defined as an event that it was unpredictable ahead of time, was not foreseen, has what they call retrospective predictability. So when you look back, you think, oh, of course I could have seen that coming, but no one did looking forward. And it has a rather substantial impact on the financial markets. This was coined and popularized in a book by Nassim Taleb several years ago, a prominent economist and financial commentator. So this is a representation of others that have happened in the past, and everything from Brexit to right back to a number of others, such as the first Gulf War. The consistency is that they had an impact on the market, but they all inevitably also showed a recovery. Some recovered quickly, some took longer to recover, but they all ultimately did recover. And whilst we can't necessarily say, let's look at what happened in SARS, or let's look what happened in the 9/11 attacks and apply it to this experience we're in now, because it is different. It is pandemic. It is on a more global scale. What we do know is that through the cycles and through the last 100 years of data or so, that we know it will recover, and that it will recover over a period of time. And for that context, for a person who's managing a longer term investment, we're not so worried about whether the market actually did bottom out on the 19th of March, or whether it will do that next month or even next autumn, if it goes up or down 10 or 15% in that time period. What's more important is how you're aligned, as we said a moment ago, to that longer term plan. So we're not worried so much about the short term markets, but more about the long term trends in cycle and your alignment to where you need to be. Ed, do you want to pass back now for some more? Oh no, I'll do this one because it's about some of the things on Australians, if that's all right. I'll carry on here. So I want to talk a bit about Australian superannuation. And I think in some of the questions I've had from Australian clients in the last month or two is how they manage their Australian super in this volatile market. And our main responses are pretty consistent with what I just said before, that it's really about how long you have to retire. But if you're getting really close to retirement, as you get closer, you gradually might want to be moving more conservative and more preservation based in your asset mix, because you're now holding on to what you have, and you might not necessarily have the time for recovery. If your time frame is longer, and you do, it might be appropriate to maintain a more growth focus, depending on your risk profile and your goals as well. But you don't necessarily need to make other drastic changes, as long as you're in line with that and you know what your preservation or your accumulation state is, and to when you can access that investment. So the principles are consistent across most investments. There are a couple of changes in the short term, though, in relation to COVID-19. The one is that the Australian government has offered an early access to superannuation, which some of you may be aware of. Again, like any other mortgage holiday or other financial tool that's been made available in response to the challenging environment that many people find themselves, whilst there is the attraction of, I can potentially get 10,000 Australian dollars now before the 30th of June and another 10,000 in the following quarter, you need to really carefully consider the impacts of doing that. So there is a process to go through. You can do it. It's not taxable. You don't have to include it in a tax return in Australia if you're doing one. You do need online access through MyGov in Australia, and it's open to Australian citizens and permanent residents. So anyone that holds a passport, whether or not you're considered a taxpayer there and you've got superannuation there, you can be eligible to do this if you think you need it. You need to be unemployed, or you had your working hours reduced by 20% or more or you're self-employed and your turnover's gone down. The other curveball, I guess, is if you've been outside of Australia for a long time, you need to have an Australian bank account in your own name or in joint names. And I've talked to a couple of clients who've looked at this, and you can open an Australian bank account online, but you need to turn up at a local branch in Australia and verify your identity within 3 months. So if you're here and you're in Europe and you think you might need it, there are a few hurdles like that. So just to be aware of that. So you should really be getting advice from someone in Australia about your superannuation and doing your own, or with them, your cost benefit analysis to see that it is in your long-term best interest to do that, weighing up that short-term need of cash now versus the lost compound interest and growth that you can have and what impact that might have on your retirement planning. So it's good to know that it's there. You can go to the ATO's website and through MyGov go in and get more information. They have extended hours on their phones as well. If you can sit online and wait for those calls, they will provide you pretty helpful advice on over the phone as well. So that's there for Australians in Europe. The other really important thing that we've been speaking about since it came up last December is the changes to capital gains tax laws for non-resident Australians. That's pretty much everyone who's living in Europe who's an Australian passport holder and or who's not and owns a property in Australia. There's a current 6-year exemption from capital gains tax on your primary residence. That's changing. The law went through assent in December, and I think it was put up in December, went through assent in April, and is now into law about this, and it applies from the 1st of July. We've put quite a bit of detail on the next couple of slides, but you can also get this. There's quite a bit of information on the government website and also the ABC in Australia as well. So basically what they're doing, if you're living outside of Australia and you sell a property, your primary residence might have been your main home and you've moved out and rented it out while you're living away from Australia. If you sell it after 30 of June, you may have to pay capital gains tax, even if you've been away for less than 6 years from 1 July onwards. There are some details around when you actually purchased it, but they have also the consideration to value the capital gains not at the date you left Australia, but at the date you bought the property. And that can have a major impact. If you left in 2007, but you bought the house in 1989, that can have a really big impact for your finances later on. So what can you do? You can sell it potentially before 30 June, but we're already in May and it takes quite a while. It takes a good 6 or 8 weeks to sell a property in Australia, I think. So you'd have to do that fast, and it's a big decision to make very quickly to avoid capital gains tax, or continue to hold the property and deal with that later. For the time that you were away, you may have to get valuations done on your return to Australia if you do return, and obviously get proper tax advice around that, or become an Australian tax resident so that you're potentially not in that bracket of the non-resident people who are impacted by it. There are some grandfathering provisions depending on when you bought the property, and rather than bore you with all the details, I probably direct you to go to the Australian Tax Office website and get the details. But it is important and has been overshadowed by a number of other things going on. We had the terrible bushfires in Australia earlier this year, and then straight after that we're now in this COVID-19 pandemic. So news like this has been pushed away from the main news channels as we would otherwise hear it. So do go and look into that if that's you and it's something that you should be potentially thinking about. Ed, I'll pass it back to you.
Thank you very much, David. Yeah, so here are just some fundamentals, some basics as to how you can help put together your own financial plan and your own investment portfolio. There are 4 things that we call the known unknowns, which can stop you or cause a hurdle on your way to achieving your financial goals. The first, as we spoke about earlier, is inflation. The reason we call these the known unknowns is because we know they will exist and they will have an impact on our financial plans and our financial life, but we don't know exactly how much or when. So inflation, as David said, Western governments try to keep between 2 and 3% per year, but in the late 80s, for example, many developed nations had inflation running above 15%. And as David showed from the graph of the EU inflation rates over the last 30 years, there have been times when it's even been negative. So we know it's going to be a factor, but we don't know exactly how much. So we have to plan for that flexibility. Secondly, taxes. Very important for us as international professionals. We may be living outside the country that we're from, or have assets in different countries, different currencies, different jurisdictions, different regulatory environments. So we know that taxes will apply, but even in one country, those can change from one year to the next. So we've got to plan for them and make every provision that we can to make sure that we're being tax efficient. Thirdly, we've got investment risk, or investment and risk, because every investment has some form of risk. And as I said at the beginning of this presentation, we know that markets will go up and down over time, and that cycle will continue for as long as capitalism is around. But we don't know when those cycles are going to be. We can use that approximation that they've been on average 7.5 years from peak to peak or trough to trough. But if we just stick to that rigidly, then we could really have some hiccups. For example, within the last 20 years, there have been 4 major crashes in developed markets, whereas in the previous 15 years, there was only 1. So we've got to take care with what we're doing regarding risk and make sure that we're diversifying to avoid it. Fourthly, we have human problems, external factors, something to do with your health or your lifestyle or your family. If you were to lose your job or become sick, or if something external happens like we're experiencing now, where perhaps you might be forced to work from home, or in some cases you might not be able to work because you're confined to your home. Having kids or moving to a different part of the world, all of these things will have an impact on your financial plan. So understand that they'll happen and make sure you've got the flexibility to deal with that if you're not expecting it, or also make sure you've got the diversification to defend against it should it happen at any time. And that's the best way to push forward to your goals. Now on this next slide here, we've got a little bit about the process that we use when talking with clients and anybody that's asking for our advice. First consideration is always compliance. If you're not compliant with tax regulations and the structures that are authorized for you and your investments where you're living and anywhere else where you have to report your taxes, then it's potentially damaging to the future returns you're going to get. There may be financial penalties, there may be aggressive taxation on the assets that you have, not just in those investments, but potentially all of your portfolio. And therefore, making sure that you're compliant is the best way to start out. Liquidity is the second essential rule. You've got to have enough in your rainy day fund. Now, we typically recommend that every investor should have between 3 and 6 months of either your regular monthly expenses or your income after tax, whichever you feel is more appropriate to your spending patterns and your needs if everything goes wrong. If you've got less than 3 months, then you're opening yourself up to too much risk in the case that there's a big external impact to you. If you've got more than 6 months, you're opening yourselves up to a big risk in terms of inflation or other forms of pressure that might reduce the value of your money in terms of your spending power. So having that amount of liquidity that's not too little and not too much is essential to every investor. Flexibility and the ability to change not just your plans and goals, but the everyday structure and ethos of your investments is very important. You don't want to be tied into something that might not be suitable 10, 15, 20 years down the line. You want to be able to make changes as your life changes, and we know it will. Volatility is just a way of talking about how predictable or unpredictable any particular investment is. And it's a consideration after we've got the flexibility. If we have that flexibility in place, then we can manage volatility to some extent and move to investments that might be less affected in certain circumstances. But we need to understand that those market movements are always going to happen, both upward and downward. After this, we then finally consider costs or charges and returns. Now, I'll always club these two in kind of together, because something might have a very high cost but very high returns. So therefore the relative cost is not so much, but something with a very low cost and very low returns is relatively more expensive. So we've got to consider these together, but we put them to the end, because returns are a benefit of investing, not a reason to invest. We focus for ourselves and our clients on goal-based, target-based investment, and therefore the returns are a consideration of how effective those investments have been, not a reason that we should pick a particular investment. So just to sum up, first of all, we know that over time markets trend upwards, but that will never be a straight line. If markets go up and up and up and up at the same rate forever, or down and down and down and down at the same rate forever, it's the end of capitalism. Everybody's making money or everybody's losing money, so nobody is doing anything. We know that some of those deviations will be more than others, and some will be smaller. So we have to expect these changes in the market over time. We've also seen that after the impact of the pandemic, governments around the world and central banks have tried to influence and steady the markets to reduce volatility and to support equities. This has certainly produced a short-term effect in causing a bounce and a medium-sized recovery from the initial crash, but the total results aren't in yet. We don't know what's going to happen in the next 3 months, and there may be more shocks to come as we see the impact of the shutdowns on companies in their reporting for the second and third quarters this year. The most important thing for you as an investor is focus on your goals, be target-based and check back. If you've put together a plan in one place, then make sure it's still aligned. If you're focused on your long-term goals and your strategy to achieve those, it'll help you to ignore any short-term movements and ignore any hiccups that we might see in the markets. There is support out there from governments and from companies in a lot of cases for people that need it. Check if your local government in the Netherlands or wherever you're living in Europe, in Germany, in Italy, in Spain, is providing incentives that might be able to help you, and check if your bank or any creditors that you have are providing deferrals or options for you to reduce your liabilities in order to support you during this period. If you are a property owner in Australia, have a discussion with a professional about your liability to capital gains tax. Those changes are coming in at the end of July, and you need to be prepared. It could cause you a significant bill that you weren't expecting in terms of tax, just for the fact that you've done nothing. So always be active in maintaining that your financial portfolio is still on track with your goals and targets. Always account for those 4 known unknowns: tax, inflation, external human factors and lifestyle change, and volatility or uncertainty in the markets. And make sure that you're diversified in terms of asset class and region and currency, to not keep all your eggs in one basket. It's the easiest way to protect against external impactors. So finally, always come back to those core components for the investment portfolio of any international professional. Firstly, focusing on goals and targets. Secondly, making sure you're compliant with every necessary regulation. Then we look at liquidity and flexibility, the ability you have to move with the times. And finally, we look at the risk profile and then the cost and overall returns that we can generate. So thank you very much. We're going to keep some time here for a few questions. I see that a few people have typed something there. So David Bellingham, my colleague, and I, Edward Mannering Burton from Black Swan Capital, are going to stick around. Let's
see what questions have come through.
yeah.
Jennifer, did you have any questions without
Yes,
putting you on the spot?
thank you so much for this incredibly interesting presentation. At least I can hear you now. So apologies for the strange start, and also the lack of introducing myself to those who don't know me. I'm Jennifer Tucker, the chair of ABIE Netherlands. There's so much interesting information that you gave, and as a stumbling investor who has been subject to at least 2 crashes, this being the 3rd by now, it's very interesting for me to hear what you've got to say, and also to see the pattern on what my investment choices have been in the past. In the investor bias graph, I saw myself there glaring, especially going back as far as I think probably the 90s. So, but one of my questions is, you mentioned being reactive. You mentioned managing your portfolio and, staying with the market, not being a frog in the boiling water. Yet, when do you, then also you said don't be too reactive. So what is the time? What is the right time that, you need to be focusing on in order to make those changes? Because for someone like me who doesn't understand the market, but am in the market, I don't know. And I have the scars from those crashes. And so quite often it makes me just sit in that pot of boiling water, not knowing what to do.
It's a really good question, and I know I sound like a cop-out, but the answer is always it depends on your specific circumstances. And I guess there's a balance between not reacting and saying, well, the markets are doing this, I better preserve what I've got because otherwise it's all going to disappear. And at one extreme, and the other saying, well, we've seen some market adjustments, I need to make sure I'm still balanced. And we're operating in the recent time in a market that has dropped quite a bit. It's the same as when a market has grown quite a lot. If you are, for example, a balanced investor and the market goes through a very strong year and grows 25%, you may be pushed into a more aggressive portfolio mix than you're comfortable with and have to adjust it back. Just like now when it's dropped and it's pushed you more conservatively. If you don't adjust from being pushed conservatively, you will miss out on some of that growth that comes through the next cycle because you're weighted too conservatively. The frequency with which you do it depends. We've got clients that are doing that balancing monthly. We try and utilize structures that will do it almost automatically for them wherever it's possible. So they're quite aligned in what they call a dynamic basis to the market without being reactive.
Yeah, just to add something there, it's important to be proportional with how you're reacting. So we always encourage people to be proactive in terms of diversifying and building a portfolio that's already tailored to the target from day one, so that there shouldn't be too much need for making sweeping changes. But if you're proportional to what's happening, then it means you can make small changes to react without making big wholesale sweeping changes, which is an emotional response. So it's quite often said that emotion is the enemy of investment, because we as humans we're hardwired to do things in reaction to external impactors. And so we have to try and push that out of the way. And if you think about if you were sitting at home and you felt a cold breeze through the window, would you close the window, or would you adjust the thermostat so that it's going to increase the temperature for the next couple of weeks? That cold breeze is a very short-term impactor, which has a quick fix that you can use, but you have to make sure that you don't overreact and suddenly do something that's going to cost you money in the longer term.
Thank you very much for that. So you should stay true to your investment, your investment strategy. So if you are,
it's staying true to your goal, really. What's your objective? Because the investment's just a tool to get you there. It's just a means to an end, really.
What about for people who've gone through those cycles, and you mentioned 7-year cycles, 7-year, 10-year, whatever it is. we've seen them. And a lot of people have been on those cycles where they got to a certain point where their portfolios were very healthy. And then the 7-year cycle happened, and they went back to where they started from. So what do you say to investors who are experienced or have experienced that type of situation?
Yeah, well, it's certainly something that some investors have experienced recently. For example, what's known as the lost decade in the 10 years from 2000 to 2010, when people who had put money in just before the turn of the year 2000 would find 10 years later that they had pretty much exactly the same amount that they started with. On the whole, that is an outlier. That's only happened twice in the last century. So once in the early 20th century in the 1920s or so, and once, as I said, at the beginning of the 2000s. On the whole, those 7-year cycles have recovered beyond where they started. So the 7.5 years that I mentioned earlier is peak to peak rather than getting back to break even. The break even point we would expect to see much earlier in that cycle. So typically if there's a 2-year crash, 2-year negative or bear market, then on average we would expect that to be recovered after about 3.5 years. So we know that people have experienced that, and that can really burn people's fingers. It can put people off, as you said. One interesting thing that that economists and behaviorists have found recently is that people's attitude to investment is formed very much early in their financial life, and people tend to carry their first experience of global stock markets with them for the rest of their career. So if you started your first job where you were able to save a little money during a period of negative stock markets, then you're more likely to have a negative outlook in terms of investment attitude throughout your life. And the same, of course, for people that started their first job with the capacity for saving during a positive period. And so again, that's bringing emotion into it. It's not being objective with your investments. There are a number of different methods that we can use in order to benefit from that cycle and protect against it. First would be something called cost averaging, where instead of putting all of your money into the market on day one, you're drip feeding it in. And this is particularly effective when markets are looking like they might fall and recover. So if we've had a prolonged period of growth and positivity in the markets, it's a good idea to start cost averaging and drip feeding into the market, because as things get cheaper and then recover, then you're going to benefit from that recovery. You've bought in the dip, as it were. If markets are going higher, then cost averaging can actually be a negative in terms of how it affects your returns. So it really is something to do when things have been going up for a while to protect against the dip. If you think that things might be starting to go up or might be continuing for a longer period, to have that movement month to month or year to year, there's another method called the 50-50 method, where you are cutting your losses, buying into your losses and splitting your gains regularly. Now, if the way this works in reality is if markets go up by 10%, so let's say your portfolio makes 10% in one particular really good year, you take half of that, so you take 5%, and you put it into something rock solid, even if that's just your cash in the bank. If markets drop by 10% in the following year, then you take half of what you've got in your rock solid, your cash in the bank, and you put it into the market. In a volatile period, this can have a real benefit and can massively outgrow a fully committed investment. But if things go consistently upwards in a fairly straight line, then you will underperform that because you're always putting money away. So these are just a couple of the methods we would use, but as we've said so many times, the most important thing is looking at those targets over the long term and employing the methods that are right for you in order to achieve those.
Thank you. I have one more question, and then if anybody else has any questions, please do feel free to ask the questions in the Q&A. So here's a crystal ball question. How long do you think this is going to take before the market starts getting to where it was? How long do you think that tail is?
Right. The short answer is I don't know. I don't know. We've got a number of unusual circumstances where in a stock market downturn that wasn't driven by financial principles, we have the other impactors of the global pandemic, as Ed described, with reduction in supply and reduction in demand. So demand at the retail consumer level, less people going to stores to buy things. Supply side, less stores open to sell things. And that, of course, extends at the B2B end as well, where there's less factories producing, less companies buying semi-finished material. So we're seeing that flow into the economy, and we're seeing some early news hit the press around GDP or economic growth being negative. So we're not sure what's going to happen in that short period of time, how a non-economically driven downturn in principle recovers, and what impacts things like vaccines and treatments and the natural dying out or spreading of this disease will have. So there are a number of variables that we don't know about. We wouldn't sort of gamble and say this is what's going to happen anyway. And at the risk of sounding really dull, I just go back to those longer term principles. And I would again say, if I don't really mind if it's, or care in a sense, if it's next month or the end of the year, if your time frame is long term.
Yeah, quite right, David. And another factor in our world, in the world of investment and economics, is that we try to never talk in absolutes, because whenever people talk about this crash, they're typically referring to one individual impactor and the negative effects of that one aspect. But this crash that we've just had, the March 2020 coronavirus crash on the markets, as David said, was non-economically driven, but it has had massive economic impacts that a lot of those we haven't seen yet. We don't know how the recent shutdowns and the government support of stock markets are going to affect the bond market and affect interest rates and inflation. We don't know how shutdowns and quarantine periods and people working from home are going to affect big companies. We might see, we're already seeing airlines go bust. Virgin Australia, we lost a couple of weeks ago. There are several other airlines that are in serious difficulty at the moment because nobody's flying. Tourism is certainly being affected. The automotive market is certainly being affected. But at the same time, online firms and distance have seen a boom from this. So we have no idea how those economic consequences are going to develop. As David said, it's just a case of sticking to the principles of investment and ignoring the fact that there are all these unknowns swirling around us. So we have to try and get beyond that thought of what is this doing to me, and think about what can I do towards my goals.
Thank you so much, Ed. I see there are no more questions, so unless you have any last words of advice, I would also like to ask if we could have a copy of the presentation for those who've registered for the webinar.
Sure, we can do that.
Okay. Any last words of advice for our viewers?
I would think just in last words would be that obviously it's an unusual economic environment, and therefore to be mindful of the way you might respond to volatile markets. Don't take fast reactions, but instead respond in a considerate manner. If you're unsure, go and get professional advice about what you're doing and focus on the goal rather than what the market's doing over the coming weeks. That would be my main advice in this environment.
Yeah, for me, I'd say number one is don't guess. If you try and second guess the market 99 times out of 100, you will be wrong. We always have to remind ourselves of that, as well as our clients. Don't try and second guess anything. Beyond that, remember what David was saying about the psyche and how that can affect you. And if you hear people saying these trigger phrases like you can't afford to not be invested in this,
right,
run a mile, or
that's true advice.
This time it's different, you should all jump out. That's an opportunity. So understand that these things will go on, and as long as you're focused on your targets, help you to avoid them.
Yeah. I would just like to add and just say thank you to Jennifer and ABIE Netherlands for the opportunity to present with you today, and to speak to the audience. It's a real pleasure. Thank you, Jennifer.
Very welcome. Thank you for your wise words.
You're welcome. Thank you very much, everyone.
Thank you. Bye-bye.
Okay, take care.
Bye.